Boy, I think I'm looking a little bit scruffy now. All right. Welcome, folks. Oh. Good old hanky made in the USA. 100% cotton. That's what that's what I'm using now for my mask. I can use it also for yard work and as a general bandana. It's always good to have a hanky. As a matter of fact, I think most experienced people, over time they come to have certain things that they have what they call their EDCs, their everyday carries, and I would put a good cotton cloth right there as one of those things that is a good everyday carry that you would keep in your pocket at all times. You never know you're going to need it, especially if you're working. Maybe another thing is good pocket knife, good quality pocket knife. What else? In my everyday carry, of course, I have an iPhone, and I guess the last thing I have is a nice thin wallet, enough to hold a little bit of cash and the credit cards and license and that sort of thing. What do you have as your everyday carry? What do you think is the smart thing to do? All right, so today we're going to talk about how to successfully trade options, and this is directed to people who are either frustrated with their trading or for people who are just starting out. And in either case, I'm going to probably... Oh, man. Why is somebody calling me right now? Hello. I get these... do you get... I get like... something like 5 or 6 calls. I'm going to put this on silent. I'd say I get about 5 or 6 calls where nobody's there a day, at least. So what I was saying is that frustrated traders, who does that encompass? I would say that that's got to, if you're trying day trading, or you think day trading is a good thing, that's easily got to comprise almost 100% of you. Because there's only about 0.5% of people that are actually successful in day trading. And those people that do make some money are generally not beating the S&P, and studies have shown that those people are barely making anything above minimum wage. So you got to be frustrated with something like that. I mean, you have to be. How can you possibly feel good about that? And those are the small percentage of people that are actually doing something better than losing. Most people, the vast majority of people, are blowing up their accounts, or at least 90% of their account, within the first 90 days of them opening up that account. Those are the odds. They are overwhelming odds, and they are proven through scientific study, not just one, but many studies over the years. So if you're going to tell me that you're day trading and you're successful, you're lying to me and to yourself. Maybe you think that all the work that you've put into it, all of the searching, finding this guru or that guru, and seeing success or supposed success on the interwebs with people proves to you somehow that there is a way forward with day trading. There isn't. I mean, I've been involved in this, and look, I've gone through the exact same thing. And there are formulas for people who are day trading where there is a road to success. It's very, very few people have found those formulas. They don't exist everywhere, trust me. But those people are exceptions, or they're lucky. So if you're frustrated, your frustration is not unfounded. It is born in something that is almost an absolute certainty where you're headed if you keep on going down that path. And it's not much better, although it is slightly better for swing traders, and I mean people that are trading in the near short term, looking for a couple of days, overnight trading, a week out, maybe even a couple of weeks out. It gets better for people as they go have a further and further horizon to their exiting a trade. So if you are a trend trader, for instance, let's say that you're transitioning from swing to trend trading, and you're finding that the only trades that are really making money for you are those ones that you considered that you were investing in, so you hang on to them for a while. And there's a good reason for that, too. And you see the evidence all over. So why keep on pushing towards this need to want to day trade? Is it immediate gratification? I don't know. It just doesn't work. The only thing that works in day trading is the never-ending sludge and line of supposed gurus that are out there that are coming online, taking advantage of this and I don't know, this need for people to think that there must be a way. So what's the answer? Well, the answer is that you have to find something that has an edge, and it's not day trading. You need, first of all, to find something that has an edge, a real, honest-to-goodness edge in that trading. And I've already given part of that answer. Part of that answer is the longer that you hold something, the better. But more importantly, you should find something that has an edge. Now, is it possible to find something in day trading that has an edge? Yes, it is. And those generally are the people who are making money with day trading. But they're generally working with an investment bank or a prop trading firm, and they have studied this, and they found a particular trade or a particular slice of a market that they know or have superior knowledge, and then they can do this. And they're aided by tools and systems that cost a lot of money. And they've refined that technique, and they've found an edge, but they don't advertise it. And the reason why they don't advertise it is as soon as it gets out, that edge is gone. There is one thing, though, where there is an edge for the average guy, and that is with options, because options allow you to define your own edge. And there are things within options that are stated all the time that a lot of people, for whatever reason, don't really pay attention to. And if you've been following anybody who has traded options for a long time, over time you start hearing the same thing over and over. That there is an inherent advantage to being a seller of options or a seller of premium over a buyer of options. You hear that, but a lot of people don't know what that means. So they hear it, they don't get it. They try their hand at options. They try, putting buying a call or buying a put, and they might strike it good one time and then lose and then blow up an account very quickly because of that added leverage. The interesting thing is that most of the trading platforms out there make it very, very easy for you to get in at the lower level of authorization, trade authorization for options, as if that has a lower level of risk. And then they put the things that have a much, much lower level at risk, or give you the impression that they have a higher level at risk, with a higher trade authorization level. So, in other words, you can get into doing a covered call, which, at the very lowest level of authorization, but a covered call is a very high risk-laden trade that if you don't know what you're doing, it's very easy to wipe out your account. However, they put that at the lowest level. And then right after that, they put buying a call or buying a put, which is not much different than, a little bit different, but not much different than, say, just buying stock with lots of leverage or selling stock with lots of leverage. At the next level, which happens to be the most risky way you could possibly, the second most risky way that you could possibly go with trading options is just buying a call or a put and going directional. Why do they do that? I don't know. The most risky way is actually selling a naked call. Absolutely the most risky way possible. And then above that, they put spreads and undefined risk spreads or multi-leg strategies as the highest level of risk. When in fact, if you know what you're doing, they can actually be one of the lowest levels of risk. One of them. Other than one specific type of spread, they are the next level of risk. They're much less risky than just buying a long put or a long call. And they're less risky than even a covered call, which is, in essence, a type of cash-covered, naked. Actually, why they do a cash-covered naked call as opposed to a cash-covered naked put, which is actually much, much less risky than a covered call, is beyond me. So I don't understand those authorization levels other than the fact that they're intentionally trying to draw people in to get an options account, with the idea that you're going to trade a bunch and then probably lose all your money. And they don't care if you lose your money. All they care about is that you traded and gave them those dollars in commissions and the fees that they collect, etc. It doesn't cost them anything. There is one way. Well, actually, there are two ways, but they're related. And that is, with options, being a net seller of the premium. So in other words, you're not putting on debit spreads. Debit spreads is where the cost of the of one leg of the trade is much more than the other, and you're not collecting any premium. You're not. So you're a net buyer of that option. It would be like doing buying a long option, a long call, say, and then selling another call to try to offset the cost of that, but you're still generally going for a direction and you're long that option. When you start going the other way around and then start turning it into a credit, you're into a whole different story, a whole different thing. And in fact, the most profitable and least risky way of trading, if you had enough money in your account, would be a naked put, without a doubt, because it's almost impossible to lose with a naked put. And what's the reason for that? Well, one is that if you place it far enough outside of the money, or I should say inside the money, where there's very little chance that price could come down, and now generally this is a bullish trade. So let's say that you're betting that price is going to go up, so you sell a put way below that current price, and you collect a little bit of premium, then it expires. It's almost like free money. You get it. Of course, you're paying a lot to get that small amount of money. In other words, it's using up a lot of your buying power. And a lot of people don't have a lot of buying power in their account. So that's why that they move the option call, the strike price, closer and closer to the market, where it costs them less to put on the trade. All right? But if you put it far enough away, you can collect a little bit of premium, and it goes right into your account, and it's great. I mean, you could do that all day. If you had like a $100,000, $200,000 account, you could actually make a living buying or selling puts well below the strike, well below the current market, where there's very small chance of it coming down and affecting your trade, and just collect premium all day, every night, every week. You're holding those trades, as much as a week, 15 days, 30 days. No problem. You could make a darn good living doing that. It's boring as hell, and you may not feel like you're fully using all of your supposed talents, but you can make some good money. Now, there are ways to do something very similar, but do it in a much more cash-efficient way. And that is, instead of doing a naked put. Now, I didn't really go into all the reasons why a naked put is so good. Besides the fact that you can collect this premium with very little risk, but it costs a lot to do it, and it requires you to have a lot of money. So, like they say, people with a lot of money tend to make all the money, right? I mean, if you had if you had $1 million in the bank, that's all I would do. I would just do, sell naked puts all day long, so far out of the money that it would be virtually impossible for those trades to go wrong, unless we had like a flash crash or something. And then all you do is just make sure you have just enough that it's going to protect you. The worst that's going to happen is that you're going to get assigned the stock. So if it does come down and you experience a little bit of loss, the very worst that's going to happen is that you're going to end up owning the underlying stock. It's not even going to wipe out your account. That is what the end result will be, that you'll own the stock at a huge discount than what you thought it would be priced before. It is without a doubt the perfect trade, if that's what you have to start with. If you have the kind of account that you could handle something like that, you'll have the perfect situation where you're making automatic profit, and for the privilege of putting you're writing a put for somebody else who is buying that put. So they're paying you that premium for the privilege of going short on something, which there's a 90% chance that they're going to be wrong and you're going to be right. Actually, it's even higher than that. You can make it higher. You can make it 95, 97%. And the worst case scenario is that you're going to own that stock at a much lower price should the market crash. Worst case. It's not a bad deal. Now, for most people, that's kind of out of the question. They simply don't have that kind of money to be able to secure themselves. I mean, you could do this realistically with, say, $20,000, $50,000, $100,000. You're limited to how much you could do, how many times you could do it. The lower you go, the higher you go, you can do it more often. But there is a way for people that have a small account, I mean as little as $2,000, where you could do essentially the same thing, but instead of having a cash secured naked put, you do something called a credit spread. With a credit spread, that's where you're selling a put below the market. It's a bullish trade. You're expecting it to go up because as long as it stays up by the time it expires or any time in between, you make money. You can put it far enough away so that there's a very low chance of it coming down and hurting you. Then you buy another put to reduce the cost and to protect yourself from what would be called tail risk. That is a market that just drops dramatically. Right? And you can control what that tail risk is. So let's say I wanted to control it so I never lose more than, say, a couple $100, $200, $300. And put it far enough away that I always sit there and I'm collecting $100, $200 at a time. Every time I do it. With 85, 90%, 95% probability of profit. You could do that. The odds there, if you compare that to day trading, are just 100% flipped around. First of all, you don't have to be right in terms of where the price goes. You just have to be right that it doesn't go down too far. As a matter of fact, you can be right, and the price could still go down a certain amount, a fair amount, and still make money. You're right if it stays the same, and you're definitely right if it goes up. So you're right 3 different ways. And even if it does go down, you could get assigned and you could buy the stock at a lower price. It's like a no-brainer. An absolute no-brainer. That's what you could do. There are ways in what we're doing here at Asymmetric Advisor, or what I say asymmetric options, where I can show you, not only can you do that, but I can show you how you can maximize the amount of money, the return that you make on the money that you put out, what we say the return on capital, or the ROC, and then balance that with your probability of profit, the POP and the ROC, where you can put every trade on that has a 95% chance of winning. A 95% chance of winning, and up to a 25 to 35% return on the capital that you use. So that means every time you put out, say, $100, you can make $25 or $35 with a 95% probability. And you could do that with a very small account. You could do that over and over and over and over and over again. You could do that 10 times a month. You could easily bring in 4, 5, 10, 15, even 20% a month. Of course, the higher that you go up in trying to achieve the higher returns, the more risk that you're going to take. So we have a couple of questions. How much would you need for a naked out-of-the-money put per trade? Well, it depends on the size of the stock and the put, but it can be substantial. So it really depends on the price of the stock. So the way they price this is based on how much that stock would be if it went to zero. Right? So if it's a $60 stock, you would need, $6,000 in your account. If it were a $100 stock, you would need $10,000 in your account. What day to expiration do you choose is another question. Then you ask a question about delta. In our type of trading, we don't really care about delta. We don't care about the Greeks at all, as a matter of fact. We're all about the odds. In general, our delta will come in under 30 for our spreads, usually somewhere between 14 and 25. But it's not something that we're really concerned about. Just the way that we put the trades on, that's where the deltas come out. What day of expiration do I choose? I don't care. It will depend on a couple of things. One has to do with how we place those trades and the technique that we use, which is, proprietary to our service. Doesn't have anything, it's nothing really earth-shattering, and I've taught this same technique openly in a lot of my my videos, how you can increase the odds of where you place a trade and how we take advantage of those odds. So generally I'm looking for anywhere from 15 to 30 days out, but we hardly ever bring it out to expiration because the odds increase dramatically if we target sometime before we get to that full expiration. So in other words, if we are looking for 15 days out, we'll bring in that trade or target something that is much closer to maybe 4, 5, 10 days. Or if it's 30 days out, it might be, something closer to 7 or 10 days or something like that. Alex says, I thought you were Greek. I am, but screw the Greeks. I don't mean it that way. I meant, the Greeks that are part of options, all that gamma, delta stuff, vega. You don't really need to look at that. It's really not consequential at all. But what we've been doing in our service is putting on trade after trade after trade, and because of the probability of profit that we put on, most of our trades are in the 90 percentile or higher. And we're bringing in $30 here, $60 there, $100 there. Over and over and over and over. Now that's per contract. Now you can scale that simply by doing more contracts. As your account grows, so does this strategy. And you don't have to trade a lot with the same odds. And since we've been in operation, let's see, where are we today? All right, so we're at about almost 20%. So we're almost at 2 months. We've been in it for 2 months, and we've made about just under 20%. All right, and that's really on the high side that in terms of our expectations. 10% a month, I don't think that's something that's sustainable. I think we can probably sustain something less, maybe 6 or 7% a month, for sure. Some people have been asking me about, what do you do in market shocks? Those tail risks that happen, a flash crash or something like that. Well, first of all, we never have too many trades on, so we're only exposed by whatever trade that we have on and its max loss, which is never more than, say, a few $100, $200, $300. So that's one thing that how we protect ourselves. The other way we protect ourselves is that we beta weight our trades. So in other words, we'll put on enough trades and different types of trades that even if the market goes down, there are those trades that will make money on the downside and those that will make it on the upside. So that's one way. We can beta weight our portfolio. We can also, if we wanted to, just simply buy insurance. And that's another thing that we'll be experimenting with here. Not experimenting, but employing. And that's really simple, where we simply buy puts in the SPY. We buy them going way out. And we know that they're going to provide us with a certain level of insurance. And we can buy them way, way out. And they might cost a little bit, but they won't cost that much. And they'll provide a great deal of protection for us for several months. And so in that several months, we can go unabated and do these same kind of trades and make profit after profit after profit and never have to worry about a market shock, because if we do get a market shock, that insurance will pay off. And it will pay off big. It'll probably pay off enough so that it makes more than what we've made all that other time. Of course, we're not counting on that happening. That's why it's there for insurance. So that's another way that we can protect. So what I'm proposing here for people who are new to trading or looking at day trading is that you don't have to do that. First of all, this is like a no-risk way, no-stress way of trading. And you start getting used to winning. You make trade after winner after winner after winner, and it starts getting a little old after a while. But that's what it is. I mean, you're a winner on virtually every trade because you put the odds in your favor. Not just a little bit. You've put them overwhelmingly in your favor. And the worst that's going to happen, the very worst that's going to happen, is that you'll end up owning some stock that you probably would have owned anyways. It's really a no-brainer way to trade. Puts all the odds in your favor. It requires just a little bit of study, a little bit of understanding, and discipline. And that's what we do here. When you join our service, the asymmetricadvisor.com/options, here's another thing that will mitigate your risk. I am the only options coach out there that will handhold you through the entire thing and make sure that you're accountable to everything that we do. I will mentor you live, provide live support through your entire trading experience. You're never alone. So there's some more questions here. What is your purpose of mentoring? Do you want to grow full-time traders from scratch? No. Well, I don't. That depends on the person. I'm not expecting people to become full-time traders, but I want people who want to win at trading. I know that there are a lot of people now that are working from home. Some people that maybe are semi-retired, or maybe they're retired. You could be a new trader, an old trader, whatever. It all depends on what your situation is. If you want to become a full-time trader, sure. This is definitely the way to go. Start treating it like a business. Know what your odds are. Put the odds overwhelmingly in your favor, and then start managing your money correctly. So the purpose of the mentoring is to ensure the success of the people that are in this service, to keep them on the right path. They go through maybe 2 or 3 weeks of intensive learning. It's not hard learning, but it's still learning. And then they start putting that to practice. executing, getting better. We institute a campaign method which ensures a continuous improvement process. So it's like a cycle. And after each cycle, we take a look at what we've done, find out went bad, went good, and how we can carry the good or the new ideas forward to the next cycle. And so we're continuously improving. That's what the mentoring is about. That's what the coaching is about. The mentoring is about teaching. The coaching is about keeping you accountable to do what we say what we're going to do. So our next question is, how much content in your course of volume profile? Well, the volume profile course is a relatively short course. There's not a lot to it, but it is a profound course. You can finish it within, watching all the material in a few hours. And then, of course, then it takes a little bit of study and practice to get good at it. But volume profile is one of the tools that we use to take the inherent odds that you have in these trades and then add to that. So what used to be, stock 85% probability of profit trade, by placing it properly with the understanding of volume profile, we can turn that 85% trade into a 95 or a 98% probability of profit. So the time that you put in to learning volume profile and applying it to this method is the difference between being an 85% winner and being a 98% winner. How many videos are there? Virtually every video that I do for the people in the course, and we do this often. First of all, there is a weekend seminar that we hold for the members every weekend, Saturdays at 1 p.m., that becomes part of the course material. Then I do another 2 or 3 videos during the week that are specifically for people inside of the membership that also goes and gets added to the course. So, over the course of a year, there's going to be hundreds of videos. We're just starting out, so now there's only, a couple dozen or so. But you really, it's a lot of it is repetitive or refinement or talking about very specific things that that we're learning how to do and get better at. And the best part about this is that this is not an expensive endeavor. As a matter of fact, this is a relatively inexpensive way to learn how to trade. My goal here is to get a stable of traders, maybe 300, 400 people, and I think that that is my manageable number. And then once you've been through it for a few months and you've learned how to do it, maybe you can go off on your own way and do it all on your own, or you're welcome back anytime. But that's my goal, is to churn through 300-400 people every few months and teach them the skill. They're welcome to stay and then pay a small monthly fee for the alerts that we put out, of which so far are 100% winners. I should say, more accurately, that I would say that they're 97% winners, because there was one trade that I'm not going to qualify as a winner, but it was flat. It wasn't a loser. I guess not a loser is still a winner, but that was one trade out of many. I'd love to see your videos and the various forms of technical analysis, the pros and cons of each. I don't provide anything like that, Alex. All I can tell you right now is that technical analysis is bunk. You do not need technical analysis. And that's one of... There are certain technical techniques that I think have some value, but in general, you do not need them. Technical analysis as a strategy is a losing strategy. And that's what most day traders are going on. We don't do any real technical analysis. Volume profile, I wouldn't even consider, I guess, there is some technique or technical aspect to it. But it's really no different than looking at a bar chart, to tell you the truth. Very, very simple. Very simple to understand the market structure, and then once you understand the market structure, place trades that are in line with that market structure. But from a traditional sense, that is nothing like, overbought or oversold or anything like that. So I don't go into technical analysis in great detail. I guess, it doesn't hurt, but it doesn't really help. So why put the time into that when you could put it into other things that, provide, 99% more value? And that's what we do. So I can't see any reason why someone who has been trading for a long time and really, find themselves going up and down, and just, every so often you have that glimmer of hope that maybe you've got it this time, but then you jump back or step back again. Do this, and you'll never experience that again. You will experience nothing but going forward, making a little bit of profit, stepping up, building your capital over and over and over and over again. That's where you'll be. And you'll never have to look at another day trading strategy or overbought, oversold indicator again, ever. You just put the odds in your favor and trade smart. Yeah, Chris, that's about right. There are about 2 videos. The whole thing is about 3 hours long, and but the study of volume profile, really, to get good at it, or to get the actual basic concepts, doesn't take more than a day. But to get it driven into your head, I think takes maybe a little bit longer of just experiencing the different trades and seeing it happen for yourself, and seeing the behavior unfold, and then that's when you really get it. Because, that in of itself is transformative for most people when they understand volume profile and actually can see where the market is finding value and where it's not finding value. Then, to take this method of taking spread trades, put credit spreads, and then laying it on top of those areas in the volume profile, it's unbelievable what advantage you have there. Because without volume profile, we can put something together that is fantastic. But with volume profile, it brings it to a level where it's now a no-brainer. Why anybody would not trade this way is beyond me, once they know about it. I can't see anybody that has, once they've found out this way of trading, why they would ever look at anything else. We have an inherent edge built into this as well. And those are things that you'll learn in this course. You'll learn why option sellers have an inherent edge built in. It's like the same edge that a casino would have. When you go to a casino, whether you're playing blackjack or roulette, it doesn't matter. The house has a very, very specific edge. They know that if you're sitting at that table and you play enough hands, no matter what happens, they are going to make money after you've gone beyond a certain number of hands. That's because they have a definitive edge. Our edge, we also have a definitive edge, and it's way bigger than a casino. You could drive 20 of those edges of a casino into our edge. So you don't have to do, 100 hands, to start realizing your wins. As a matter of fact, you don't have to do 5 hands before you start realizing the winning way of what we propose. So if you'd like to take advantage of this, if you want to try this out, I mean, I would go so far as to say that if you do not make money within, let's say, 2 months, you got to give it 2 months, 1 month of study, 1 month of practice, I'll give you your money back. No risk to me. I know it for a fact. I'll just give you your money back if you don't make money. It would be beyond me how you couldn't make money. I mean, the only way that is there a way that you couldn't make money? The only way that you couldn't make money is if you just don't do what we tell you to do. If you see, the thing is with technical analysis, these gurus that are out there are selling you what they are claiming is some sort of prescribed formula. You know, you sell when it's overbought, you buy when it's oversold, right? And then they'll tell you, that you have to take your losses with you. You know, you might be a 60% winner, and you get that 10% edge. The problem is that when you lose, it's so big that you can't overcome that 10%. But if you use a lot of hard work and you get over your emotions, then you can do it. It's such bull. If that were the case, then these studies that are showing people doing this stuff, where virtually everybody is a loser, wouldn't be true. It just doesn't work. Technical analysis is not a strategy, first of all. It is an analysis method. And to use it as a strategy, or someone telling you that it is a strategy, is telling you something, in my view, almost bordering on criminality. So that's all I've got to say. Look, I'm going to go on vacation. I'm going to go visit the islands, Martha's Vineyard, but I'll still be online. Take advantage of this now. I'll still be working a little bit. I'll still be available even on the vineyard. That's how easy this is. I mean, fortunately, the phone, I can do everything from the phone. I can do everything right from the phone while I'm on the beach. It's kind of sick, though, but hey, what the hell? I'll be on the island. I imagine that the island is, watch out for sharks, I've heard, but I won't be in the water too much. I would imagine that attendance on the island these days is way down with the pandemic. But that's okay. Join now. Go to asymmetricadvisor.com/options. Sign up. It'll be the best decision you've ever made. I guarantee it. I guarantee it will be the best decision that you've ever made. Or, you could say even Google asymmetric advisors, right? Check out what other people that are in the service right now are saying. When you Google the words asymmetric space advisors, you'll see our business listing on the right-hand side on the Google search. Check out the reviews. See what other people are saying about this service. Between that and the guarantee I'm giving you, there is absolutely no way to lose. And I'm telling you, right from the start, that will we lose every once in a while? We have to. I mean, the odds are with it. So even if you're a 98% winner, there's still going to be that 2 out of 100 times that you're going to lose. So that is definitely possible that we will lose. But even in those cases, I can mitigate it, those losses, and turn them into something that aren't losses, but are just non-wins, which is different. So in other words, we don't get what we expected. We get a little less than we expected, but we don't actually lose money. So I can almost say that not only is it we don't lose, I can say that. I can say that we never lose. Because we are the casino, as Alex has said there. We become the casino, and we put all the odds in our favor. All right. That's it. This is particularly good, as I said, for people who are beginners or people who are frustrated, which should encompass about 99% of you people. Thank you very much. Got to get back to work. We'll see you.